We're going to bring in now Matt Grudnoff. He's senior economist at the Australia Institute here in Canberra, and Peter Martin is economics editor at The Conversation and visiting fellow at the Crawford School at the ANU. Matt, why don't we bring it over to you with the pressing question, I suppose, today. Both men on the podium there at the Press Club were asked about spending cuts on one side or potential tax increases. Neither gave crystal clear answers. What are they trying to hide?
Yeah, well, that's a big question, and the reason they're trying to hide it is because both sides of Parliament, whoever wins on the 21st, is taking a bigger spending agenda. Whether you're interested in childcare, aged care, the NDIS, whether or not you're worried about China in the Indo-Pacific and you want more defence spending, they're all going with larger spending commitments, but none of them are going with any kind of revenue raising exercises. And
so Matt, why can't we just grow the pie? Why can't we grow the economy and it yields unto governments vast riches of taxation? Why is that not feasible?
Well, I mean, because that's just not how it's going to work. Like, if the economy gets bigger, then expenses that the government have to fork out for also get bigger. Look, certainly growing the economy is one way, and it's an important way, but there's no guarantee that the governments are going to be able to grow the economy in the long term. If to do that, then they would have to be talking about productivity. They'd have to be talking about participation rates, and at times they do that, but I don't see a huge radical agenda to increase productivity, and so this idea of well, we'll just magically grow the pie, that's just a way of avoiding having to have a conversation about raising revenue.
All right, well, let's have that conversation, Peter Martin. Politicians rise and fall in 3 yearly cycles, generally speaking. Is there an inevitability within the next 3 years, Peter, that the taxation side of the ledger will have to be addressed by the next government?
There's an inevitability that tax will increase, so I guess that's right. What we've seen over history, that the graphs only go back to the early 70s, is that every time there's a big increase in tax, doesn't matter what for, there was a big increase in the 70s, a big increase in the 80s, Medicare was part of it. Spending jumps up and then tax jumps up soon after, and they don't go down. Everyone knows this. Now, there is, to be fair, I think I understand what you're saying, Matt, but to be fair to the government, they actually did find a secret source for growing more revenue. The last budget was sort of proof of it. By driving the unemployment rate down, they actually driving it so low that, where we haven't been for 5 decades now. By doing that, they actually did get a lot more revenue. It wasn't an increase in productivity, but it was people paying tax who never would have paid tax before. Some of them haven't worked for a decade or so, and these people were now working, and that actually, and you can see in the budget how that improved the finances.
But so this is finite, is it, Peter? I mean, unemployment can only go so low.
You can't get unemployment down to zero, but New Zealand has unemployment in the low 3s. Australia once had it at 2%. New Zealand once had it at 1% unemployment in the 70s. So such a thing might be possible. But more broadly, even if you do that, there are such demands on the budget, demands not really talked about. There's the response to the Aged Care Royal Commission, the response to the Disability Care Royal Commission. Governments have said they're going to do that. Governments have said they're going to fund the higher wage rises for aged care workers that are before the Fair Work Commission. They've said that they're going to do all of these things. They will require more money. Governments have committed to them. Now, Labor is more honest in this because Labor hasn't committed to any limit on tax, whereas the Coalition has delivered a lower tax guarantee, whatever that means, at a time when it's also committing to do all of these things to properly fund services.
And of course, both sides. Yeah, go ahead, Matt, and then I want to take you to interest rates. But Matt Grudnoff?
A big reason why the unemployment rate is as low as it is right now is because the government dropped a lazy $200 billion in stimulus, which was a good thing. It kept us out of recession, but it worked. It worked really effectively at growing employment, and now we have very low unemployment rates because the government has stimulated the economy. But that comes at a budget
That's right.
cost.
And it actually sort of paid for itself. Okay, so the government ran up debt, but the size of GDP, the government's ability to service that debt was helped by doing that.
There is a bit of a hangover for the budget, that's for sure, from that. Now, interest rates, we all watched, and in some cases people seemed surprised. I'm not entirely sure why. The Reserve Bank Board increased interest rates by 1/4%. And now, I think both of you share a view that this may not have been strictly necessary under the economic circumstances. Matt Grudnoff, you lead out first, and we'll try and discern if there's any split between the pair of you on this one.
Sure, usually when the RBA is increasing interest rates to control inflation, it's the kind of inflation caused by excessive demand. The economy is going along at a ripping rate, real wages are rising quickly, businesses are putting up prices because there's huge demand for their goods and they can't quite keep up. And the RBA increases interest rates, people have less money to spend because they're spending more on interest and less on everything else. That means that the demand is taken out of the economy and inflation comes down. But this inflation isn't like that. This inflation is a more rare form caused by supply shocks. That is, there's some massive event that's hit the economy and it's caused costs to increase. So, you know, is increasing interest rates going to bring down the world price of oil? Is it going to bring down the price of gas? Almost certainly not. It doesn't matter what we do in Australia with interest rates, petrol prices are going to remain high until we see solutions overseas.
All right. So Peter, yeah, not to cut you off, Matt, but just to pick up any similarity or difference in view here, if the factors might correct themselves internationally, what's your view? The bank could have kept it at 0.1% for quite some period of time?
I think the bank was fairly honest. If you read what it said, it didn't say anything about this will control inflation. It referred to the success of getting out of COVID. It referred to normalising things. It referred to getting rid of extremely negative real interest rates, way below the rate of inflation. It didn't really say it would fix inflation. A lot of people have been saying in a knee-jerk sort of reaction, oh, inflation side, therefore you need higher interest rates. Usually true. Not true in this case. It's doing it for other reasons. Now, what I would add to what you've said, Matt, is that the good news appears to be happening. So in the last fortnight, the world oil price is down 2.5%, right? It's down 11% from its peak. The Bureau of Statistics gives us the inflation news with a lag and only every 3 months. Setting interest rates has been described as trying to drive looking through the rearview mirror. The Melbourne Institute of Applied Economic and Social Research does a quicker and dirtier survey each month, but it tends to track the official survey. It found, incredibly, in April, that's 1 month, the month after the official inflation figures, the month we've just had, that prices increased overall, not at all. That is to say, the monthly increase in prices was actually minus 0.1%.
And why would that be, Peter? Is that taking out fuel
petrol?
And yeah.
And that takes into account the government's budget measure on petrol. It takes into account how the price of oil was falling. The price of wheat has stopped rising. So a lot of these things, I agree that these interest rate hikes aren't going to help.
Yeah. Last thought,
a lot
Matt.
of these things are fixing
wrap it up
themselves.
There. Go on.
Yeah, a lot of these things are fixing themselves.
Yep. All right, Matt.
With luck.
Yeah. Just one thought on growth rates. Finally, to round us out, Matt. 2% says the Reserve Bank for the calendar year. 3 and a bit for the financial year coming, says the budget. Who's right?
Well, yeah, I don't know. What do they say about economists? Macroeconomic forecasters exist to make astrologers look good. Economists can't predict what the interest rate's going to be by the end of the year with any sort of accuracy. Look, I mean, with rising interest rates, with falling real wages, it's likely that it's going to be more like 2 than 3. If the inflation rate comes back down, if wages actually do take off, and there's been no solid evidence that wages have increased increase.
Yep.
But if that does happen, then we'll probably be closer to 3.
And we'll probably be getting both of you back for some further analysis at or around that time. Peter Martin and Matt Grudnoff, Peter from The Conversation, Matt from the Australia Institute, thanks for joining us today.
Thanks, Greg.
That's good.